pertain to the permanence and durability of the banking franchise.
Oh, yeah, sure.
And whether alternative delivery channels over the next few years may erode the durability of that, including the Microsoft and Intuit merger.
Well, that's a good question. You're certainly seeing the value of bank branches diminish significantly. It used to be a point of enormous pride with managements in how many branches they had, and it was often political influence and everything else was called into to obtaining branch permits. And the world will change in banking probably in some very major ways over a 20 or 30-year period. Exactly what players will benefit and which ones will be hurt, is a very tough question. But I would expect. I don't think I'd expect really significant change in banking over the next 5 years, but I'd certainly expect it over the next 20 years. And there are a lot of people that have their eye on that market, including Microsoft, as you mentioned. It may be to their advantage to hook up with the present players. I mean, I know it's certainly something that gets explored, but they may figure out a way to go around the present players too. And that's one investment consideration. Charlie?
Yeah, the interesting player that went around the rest was Merrill Lynch. Merrill Lynch went heavily into banking with its cash management accounts. And I don't think it's the only innovation that'll come along.
What's the name of that book?
I've forgotten. That's a marvelous book.
There's a great
Maybe
book.
Molly remembers. What was that book you gave me? It was the history of the credit card.
Was it Joe Nocera's or? Yeah, Joe Nocera was the author. I don't remember the title, but came out about 6 months to a year ago. It's a terrific history of the credit card business. And if you read that, you will get some idea of the amount of change that can occur in something like the movement of money. And my guess is that if there's another edition of it in 20 years, there'll be plenty more to write about. So,
by the way, that is a fabulous book. Most of the people who are here will not be able to put it down. I mean, for a book about an economic development, it captures the human background in a very interesting way.
Zone 4.
Edward Barr, Lexington, Kentucky. Earlier, you led us through a discussion of the competitive position of Disney, and you also discussed share repurchase. I wondered if you could also lead us through a discussion of the competitive position of Wells Fargo, since they just effected such a large combination, in addition with perhaps some discussion of their share repurchase, which is probably as large in percentage terms as any company I can think of at the present time.
Well, Wells should repurchase their shares if they feel that they're repurchasing them below intrinsic business value, and that's a calculation that they make, and you should have to ask the question of them what their calculus is of that. But that will determine whether that share repurchase program makes good sense or not. The advantages of an in-market merger can be dramatic. Sometimes it just causes a bank to do what they should have done anyway. I mean, I'm not as always as convinced that the economies come about totally through scale as they are just from taking a hard look at how they run their. In the audience today, he was here earlier. The CEO of the Bank of Granite, which is in Granite, North Carolina, and that bank earned 2.58% on assets, I believe, in the most recent quarter annualized, and had a 33% efficiency ratio. Now that bank is $400 million or $500 million of assets. It doesn't need to be $5 billion in order to get more efficient or anything of the sort. It's so much more efficient than any of those larger banks that had to be put together to get those ratios that it makes you kind of wonder about the underlying rationale. But I'm sure that Mr. Forlines, who runs that bank, just focuses on, and he's been focusing on it for a lot of years, just doing the right things day after day, and it didn't take any in-market merger or anything of the sort to cause him to do that. I recommend any of you in the banking business that get his report, because there is nothing magic about the community of Granite, North Carolina, nor does he work under laws that are way different than the rest of bankers or anything of the sort. He just gets a record that achieved a record that that makes all the rest of the records look silly. And we had a fellow over in Rockford, Illinois, in the bank we owned back in the 70s, Gene Abegg, who his brother is going to be 104. There was a fellow from Rockford here that got me to sign a note to Ed Abegg, who will be 104 soon. I wish Gene had lived to 104. But Gene ran a bank in Rockford that when the best banks were earning 1% on assets, he earned 2% on assets. And he did it with way less leverage than anyone else and lower loan losses and big investment portfolio. And there wasn't any magic about it. He just didn't do anything that didn't make sense. And there's a lot of room for improvement in the banking business with or without mergers. But I would say that Wells, on the record, has done an exceptionally good job of running their bank compared to other big banks. And I would say that those two operations put together will be run a whole lot more efficiently than if First Interstate had been run on its own. It's a business that can be a very good business when run right, as the Bank of Granite or our Illinois National Bank in Rockford proved. There's no magic to it. You just have to stay away from doing something foolish. It's a little like investing. You don't have to do anything very smart. You just have to avoid doing things that are ungodly dumb when looked at about a year later. And, airlines and that sort of thing. And that's the trick. It is not some great crystal ball game where you look into the future and see all these things that other people can't possibly see. I mean, what's complicated about Coca-Cola or Gillette or Wells Fargo for that matter? And that's we like businesses like banking if we've got somebody in charge of them that is going to run them right. We've got I don't know whether Bob Wilmers is here, but he runs First Empire, which we have a good size investment in. And Bob just runs it right. I do not worry about surprises from Bob or First Empire, and he'll do things. If he can grow and it's logical, he'll grow. And if it isn't logical to do something, he'll pass. He has no ego compulsions forcing him into some sort of action, and he runs a terrific bank. Charlie? Okay.
My name is Steve Sondheimer. I live in Chicago, and I'm 14 years old. I'm a third-generation shareholder. And my question is, I noticed that you sold our position in Freddie Mac. What risks do you see in that industry?
Are you Joe's granddaughter? Or?
Yeah.
Ah, good. We have an amazing number of second and third and even fourth generation shareholders, which I'm delighted with. I mean, I don't think lots of companies, big companies on the stock exchange are in that position. It is true we sold the Freddie Mac stock last year, and there were certain aspects of the business that we felt less comfortable with as they unfolded, and Fannie Mae too. And the consequences of what we saw may not hurt the companies, I mean, at all, but they made us less comfortable than we were earlier, when actually those practices or activities didn't exist. We did not. I would stress we did not sell because we were worried about more government regulation of Freddie and Fannie. If anything, just the opposite. So it was not. Wall Street occasionally will react negatively to the prospect of more government regulation, and the stocks will react sometimes short term for that reason. But that was not our reason. We felt the risk profile had changed somewhat. Charlie?
Yeah, but that may be a peculiarity of ours. We are especially prone to get uncomfortable around financial institutions.
We're quite sensitive to risk, in whether it's in banks, insurance companies, or in what they call GSEs here, in the case of Freddie and Fannie. We feel there's so much about a financial institution that you don't know by looking at just figures, that if anything bothers us a little bit, we're never sure whether it's an iceberg situation or not. And that doesn't mean it is an iceberg situation in the least at banks or insurance companies that we pass. But But we have seen enough of what happens with financial institutions that push one way or another, that if we get some feeling that that's going on, we just figure we'll never see it until it's too late anyway. So we bid adieu without, and wish them the best, and without any implication that they're doing anything wrong. It's just that we can't be 100% sure of the fact they're doing things that we like. And when we get to that situation, it's different than buying into a company with a product or something, or a retail operation. You can spot troubles usually fairly early in those businesses. You spot troubles in financial institutions late. It's just the nature of the beast.
Really? Yeah, financial institutions tend to make us nervous when they're trying to do well. That sounds paradoxical, but that's the way it is.
Financial institutions don't get in trouble by running out of cash in most cases. Other businesses you can spot that way, but a financial institution can go beyond the point, and we had banks 10 years ago that did that in mass, but they can go beyond the point of solvency even, while they still have plenty of money around. Area 6.
Hello, my name is Everett Fury. I'm from Atlanta. I wanted to ask you to comment on the relative PE multiples of bank stocks versus the S&P. They seem to be at 35 to 50-year relative lows to the S&P, and I was wondering if that's a result of the market, a change in the market's perception of the forward growth rates of banks, or if the market has perceived that there's a change in risk there.
You're asking about the performance of what group compared to the S&P?
Banks.
Banks? Well, and what was your assertion about the performance historically?
Well, the relative multiple of bank stocks versus the S&P. Back in the 40s, 50s, 60s, they commonly traded at, say, 1 times an S&P multiple, and now they're maybe half that level.
Yeah, Harry Keefe used to have a lot of figures on this, and I don't really think about them. I mean, the appropriate multiple for a business relative to the S&P will depend on what you expect that business to achieve in terms of returns on equity and incremental returns on incremental equity versus that S&P. I mean, if you've got two types of businesses, and we'll say the S&P earns X on equity and can deploy an additional amount of capital at Y, and then you compare that with any other business, and that's how you determine which one is cheaper. I would not characterize all banks as the same. I mean, we have in this room John Forlines, who runs the Bank of Granite, North Carolina, and they've earned 2% on assets without taking any real risk for decades, and it's a tremendous record. And then you have other banks that have been run by people that took them right into the ground. I mean, whether it was First Pennsylvania going back 30 years ago, I think it was John Bunning, and they're not a homogeneous group. We own stock in a couple of banks. We own stock in M&T that has an exhibit downstairs today. We own stock in Wells Fargo, and we think those institutions are somewhat different than other businesses. So I don't think it goes back to that earlier question. People always want a formula. They go to the intelligent investor and they think, somewhere they're going to give me a little formula and then I can plug this in and then I'll make lots of money. And it really doesn't work that way. What you're trying to do is look at all the cash a business will produce between now and Judgment Day and discount it back at a rate that's appropriate and then buy it a lot cheaper than that. And whether the money comes from a bank, whether it comes from an internet company, or whether it comes from a brick company, the money all spends the same. Now the question is, what are the economic characteristics of the internet company or the bank or the brick company that tell you how much cash they're going to generate over long periods in the future? And I would come to very different answers, on M&T Bank versus some other bank. So I wouldn't want to have a single yardstick or a relative PE that I went by. I think that banks have sold A good many banks have sold at very reasonable prices. We bought all of a bank in 1969. We bought a bank in Rockford, Illinois. Charlie and I went and we must have looked at a half a dozen banks at that, in a 2 or 3 year period.
Absolutely.
Yeah, we trudged around and we found some very oddball banks that we liked. And they were characterized by very little risk on the asset side and very cheap money on the deposit side. And even Charlie and I can understand that. And low prices, incidentally, too. And then they passed the Bank Holding Company Act in 1969, and they killed off our chances to do anything further in buying all of banks. So we look at banks. We will own bank stocks from time to time in the future. We'll probably buy stock in other banks. We've also seen all kinds of banks ruined. I think it was, what was the fellow, M.A. Shapiro, who came up with the statement. He said there are more banks than bankers. And if you think about that a bit, you'll see what I mean. There have been a lot of people that have run banks in a very injudicious manner, but that's made for opportunities for other people. A lot of banks have disappeared over time. I mean, up in Buffalo, where Bob Wilmers runs M&T, there were some other very prestigious institutions that went right down the tubes, and a lot of that happened in the early 90s or late 80s. So I wouldn't look for a single metric like relative PEs to determine how to invest money. You really want to look for things you understand and where you think you can see out for a good many years in a general way as to the cash that can be generated from a business. And then if you can buy it at a cheap enough price compared to that cash, it doesn't make any difference what the name attached to the cash is. Charlie?
Yeah, I think the questioner is maybe even asking the wrong people that question. I would argue that Warren and I have failed to properly diagnose banking. I think we underestimated the general good results that would happen because we were so afraid of what non-bankers might do when they were in charge of banks.
There are a number of banks that over the last 5 or 6 years, on tangible net worth, a number of them have a lot of goodwill, but on tangible net worth have earned over 20% on equity. You would think that would be difficult for an industry to do, dealing in a commodity like money. And of course the bankers will argue it's not a commodity, but it's got a lot of commodity-like characteristics. And you would think those kind of returns in a world of 6% long-term interest rates and much lower, you'd think that would be very hard. Well, you would have thought it wouldn't have occurred, and you think it'd be hard to sustain. We've been wrong in the sense that banks have earned a lot more money on tangible equity than Charlie and I would have thought possible. Now, I think to some extent they've done it because they've stretched out equity much further than was the case 20 or 30 years ago. I mean, they operate with more dollars working per dollar of equity than people thought was prudent 30 or 40 years ago. But however they've done it, a number of banks have earned very high returns on equity in recent years. And if you earn high enough returns on equity and you can keep employing more of that equity at the same rate, that's also difficult to do. The world compounds very fast. Banking as a whole has earned at rates that are well beyond, on tangible equity, well beyond, I think, what much more glamorous businesses have earned in recent years. And Charlie, you have any further thoughts on that?
Well, I say again, we didn't diagnose it as it actually turned out. And even worse than that, we haven't changed.
And even worse than that, we won't. No. Question about banking. Banking, if you can just stay away from following the fads and really making a lot of bad loans, banking has been a remarkably good business in this country. And certainly ever since World War II, it's the returns on equity for banks that have stayed out of trouble has really been terrific. And there are certain banks, I should say, in this country that are quite large that are earning, maybe 20% on tangible equity. And when you think you're dealing in a commodity like money, that's fairly surprising to me. So I would say that I guess I've been surprised by the degree to which margins in banking have not been competed away in something as fundamental as money. How about you, Charlie?
Well, what you're saying in fair implication is that we sort of screwed up the predictions, because banking was a way better business than we figured out in advance. We actually made quite a few billions of dollars really out of banking, and more in American Express. But basically that was while we were misappraising it. We did not figure it was going to be as good as it actually turned out to be. And my only prediction is that we'll continue to make failures like that.
It's fairly extraordinary in a world of, particularly a world of low interest rates, that you'd find financial institutions that basically doing pretty much the same thing, where A competes with B and B competes with C, without great competitive advantage, and having them all earn really high returns on tangible capital. Now, part of it is that they have pushed the loan to capital ratios higher than 30 or 40 years ago, but that nevertheless they earn high rates of returns. They earn much higher rates of returns on assets alone, and then they have greater leverage of assets to capital, so that produces returns on capital that really are pretty extraordinary. And certain banks get into trouble because they make big mistakes in lending, but it's not required of you in that business to get into trouble. I mean, if you keep your head about you, it can be a pretty good business.